Okay, now. So I'm now heading towards another one of the examination question. Again, I'm using the SBL practice examination one from the CB practice platform, and I shall be doing question number 3. What I'll be doing is I'll be doing question number 3. So let me just take you people through. Okay. The name of the question is Toobasco. The name of the question is Toobasco Company. What is it? It is Toobasco Company. Toobasco Company is a car retailer. In the reporting of financial information, the directors have disclosed several alternative performance measures. Other than those defined or specified under the IFRS, the following exhibits available on the left-hand side of the screen provide information relevant to the question. The alternative performance measures, this describes how Toobasco Company describes its performance in the annual report using non-IFRS measures. Net cash from operating activities provides a summary of net cash generated from operating activities. Statement of cash flows, potential errors, so and so, so and so. Now let's just talk about the requirements of the question. It says advise the directors whether the alternative performance measures described would achieve fair presentation in the financial statements prepare. That's number one requirement. So you have to advise the directors whether the whether the APMs described above would achieve fair presentation in financial statements. Number two, prepare an adjusted statement of net cash generated from operating activities, a reconciliation of net cash generated by operating to operating free cash flows, and an explanation of the adjustments made in so and so, so and so. Now, can you just go through this specific area, please, first? Okay, let's see. What is the requirement of the question? It says discuss, advise whether the APM described would have a fair presentation in the financial statements. So that was the requirement, that you have to explain to the directors whether the alternative performance measures which have actually been suggested, would they lead to the fair presentation in the financial statements or not? Now let's see. So if I talk about it, it says the directors of Toobasco have disclosed the following alternative performance measures. Operating profit before extra certain costs or incomes which are excluded by virtue of their size and are deemed to be non-recurring. Toobasco has often included restructuring costs and impairment losses in extraordinary items. Both items appeared at similar amounts in the financial statement. So see, what happens is that okay. So it says that the extra. Now what we need to do is that we need to mention about. I'm just writing down few pointers, which is extraordinary item presentation is not in line with the IFRS. This is not the appropriate way of excluding impact of certain items and should be this is not the appropriate way of excluding the impact of certain items and should not be disclosed accordingly. Now let's move a bit forward. It says operating free cash flow is calculated as cash generated from operations, less purchase of property, plant equipment, purchase of own shares, and so and so, so and so. Operating free cash flow is not the disclosure required by IFRS. EBITDA is defined as earning before interest, tax, depreciation, amortization, and rent. Uses operating profit as underlying earnings. In earning release just prior to financial year, director disclosed this has improved to 180 because of the cost saving associated with the acquisition of an entity 6 months earlier. Directors discussed at length record performance but did not disclose any comparable information under IFRS. And there has been no discussion so and so. Directors have not taken tax effect into account in calculating the remaining APMs. Now, first of all, what was the requirement? Advise the directors whether the alternative performance measure would achieve fair presentation in the financial statement. Now, with respect to the fair presentation, with respect to the fair presentation in the financial statements, the alternative performance measures are not part of the financial statements and their calculations, discussion, and presentation do not impact the presentation of the financial statements. Hence, however, if the accounting or preparation of financial statements is not in accordance with IFRS, then this does have an impact on the fair presentation of the financial statements. The presentation of the items as extraordinary items in the financial statements, and then the presentation of the items in the financial statement as extraordinary items, and then showing profit without these items will have an impact on the financial statement presentation. Is that okay? Do you understand this? So that was one requirement, and we have actually discussed this because he talked about asking us that what would be the impact of these alternative performance measures on the financial statement, right? Now let's move a bit forward and let's discuss further. The requirement next is that prepare an adjusted statement of cash generated from operating activities to correct from the potential errors. Now, can you do this? Can you try to do this, please? Can you try to rectify this? Yeah, can you try to do the calculation of the cash generated from the operating activities? Because see, what is the requirement? You have to prepare adjusted statement of net cash from operating activities after correcting the potential errors. Yeah, is it done? Okay, I'll just open the spreadsheet so that I could just do it on the spreadsheet and see things go about. Now see what happens is that it says Toobasco company leases vehicles to customers and often sells the vehicles to third parties when the lease ends. So basically what it does is that it leases the vehicles to the customers and sells the vehicles to third party when the lease ends. Net cash generated from operating activities for the year ended was so and so, so and so. Cash generated from operating activities is like this: 345, income taxes paid, pension deficits, interest paid, associate share of profit, so and so, so and so. Net cash generated from operating activities. Net cash from operating activities include interest received of 10 and net capital expenditure of 46 million excluding the business acquisition discussed in Exhibit 3. There were some potential errors in the presentation of a statement of cash flows. There could have been impact on the net cash generated from operating activities. Now let's just try to do this. So what happens is that corrected cash from operating activities. So what do we need to do? We need to do the calculation of corrected cash from the operating activities. That's what we have to talk about. Now, how would we do this? Let's try to discuss this. As per the question, we have got 278. What have we got? We have got 278. As per the question is 278. Then what else is there? The income taxes paid have been deducted. Okay, see, we have to eliminate the effect of non-cash, non-operating items. Associate share of profits needs to be removed. Associate share of profits 12, it needs to be added back. Why? Sorry, it's added up, so you need to remove it because it's a non-operating activity. Then interest paid of 25, that is correctly removed, right? Pension deficit payments. Pension deficit payments, I'm assuming that these are the payments into the schemes. I'm assuming these are the payments into the scheme, so I'm not gonna do anything onto them. I'm assuming that these are the payments into the scheme. Income taxes paid, again, that is also okay. So I think this is all okay. But here it says net cash from our investing activities include interest received of 10 million. Interest received of 10 million needs to be deducted. and net capital expenditure of 46 million as described in exhibit number 3. Okay, let's just see what is there in the exhibit number 3. Exhibit number 3, it talks about the different problems. It says the directors have provided information regarding some potential errors in the net cash from operating activities in exhibit 2. Cars are treated as property plant equipment when they are leased to customers. And when they become available for sale, they are transferred to inventory at their carrying amount. In its statement of cash flows for the year ended, cash flows from investing activities including cash inflows relating to disposal of cars. So cars should not be considered as your inventory. So what happens is that the cash from disposal of cars should be removed. The cash from disposal of cars should be removed. It should be removed. The cash from disposal of the cars should be removed. It says on 1st September 2007, Toobasco purchased a 25% interest in associate for cash. The associate reported a profit after tax of 16 and paid a dividend of 4 million out of these profits for the year ended so and so. Directors had included 12 million in the cash generated from operating activities. Associate was correctly recorded at 23 million. In the statement of financial position, and profit for the year of 4 million was included in the statement of profit or loss. So what actually happens is that they included a figure of 12 million in cash generated as the cash generated from investment. The associate was correctly recorded at 23 million in the statement of financial position, and the profit was included in the statement of profit or loss. So associates profit which is included, we also need to remove the associates profit also, because that's a not cash flow, that's a okay. The cars is not inventory, it's a property plant equipment, you lease it out. You don't sell them, you lease them out. You sell them, that's a disposal of non-current asset. How do you use the car? You lease them out. The cars have a life of more than 1 year, they cannot be your inventory. Share of associate profit in P&L -4. This needs to be removed. This needs to be removed. Okay, just wait a bit. Just wait a bit. Just wait a bit. Wait a bit. Wait a bit. Let me just get back to you. Now see, cars are treated as property plant equipment when they are leased to customers, and when they become available for sale, they're transferred to inventory at their carrying amount. Okay. So they say that now we are holding it for sale, not for the purpose of utilization. In its statement of cash flow, cash flows from investing activities including cash inflows relating to disposal of cars. Okay, my bad. The cash from the disposal of the cars should be included in here because it's an operating cash flow. It's an operating cash flow, it's not investing cash flow, because cars are classified as inventory. My mistake. Sorry about it. My mistake. You were right. You were right, Glady. My mistake. Sorry about that. Now, now what next is there? It says Toobasco company also acquired an overseas subsidiary during the year ended 31st August 2008. Cash generated from operating activities included a loss of 28 million as the effect of changes in foreign exchange rates arising on the retranslation of overseas subsidiary. The assets and liabilities of the acquired subsidiaries have been correctly included in the cash movement. Now see what happens is that it should not be included because it's just a movement. It's no outflow, it's no inflow. It says that you have actually applied a different exchange rate, because of this there is a gain loss. So what happens is that foreign exchange losses reversed 28, it needs to be added back, because what you have done is that you have removed it from the financials, you have discussed, you have recognized the loss, so we'll add it back. During the year, Toobasco made exceptional contributions to the pension plan assets of 33 million. But the statement of cash flows had not recorded the cash benefit of 6 million. You made a contribution of 33 million, that is okay. But you had not recorded the cash tax benefit. Okay. Cash tax benefit received of 8 million. Cash tax benefit received of 8 million. Additionally, Toobasco had capitalized the interest paid of 25 million into property, plant, equipment and inventory of 7 million. So what have they done? They've actually capitalized the interest paid. So the interest paid for the property, plant, equipment into it was what? It was classified as what? Interest paid of 25 million into the property, plant, equipment of 18 million and into the inventory of 7 million. So they have capitalized it as an asset. What should have been done? What should have been done? If it is capitalized as an asset, I repeat, if it is capitalized as an asset, it should not have been actually deducted from this cash from operating activity. See, we have deducted 25. So what happens is that interest paid on capitalized asset. $18 million needs to be added back. Now, do you understand why do we need to add it back? The reason being that you see, it's an investing cash flow. It's not operating cash flow. You paid interest of 25, okay. You deducted this 25 from 278, okay. But the problem is when we analyze this 28, we realize that out of this 28, when we analyze this 28, we realize that out of this 25, 18 is paid for the asset, so it should be investing, and 7 is paid for the inventory, so that is operating, that is okay. You add back 18, you have deducted 25, that is not correct. Then it says Toobasco has defined net cash generated by operating as adjusted for net capital expenditure, purchase of associate, dividend received, interest received. Any exceptional item should be excluded from the free cash flows. Any exceptional item should be excluded from the free cash flows. So what happens is that we have made the appropriate adjustment which we had to make. So 336 should be the adjusted cash from operating activities. This is the adjusted cash from operating activities 338. $338 is the adjusted cash from operating activities. Now, do you get it now? If there is any question, do let me know. Okay, yes, you are right. It's 6 million. It's not 8 million. It's 6 million, not 8 million. You're right. Thank you. Okay, any other questions on this, please? Okay, now what next is there? The next requirement of this question is that a reconciliation from the net cash generated by operating activities to operating free cash flows as described in Exhibit 3 and Note 4. So you have to go back to Note number 4 and what is operating cash? Where is Note 4? So it says a reconciliation from net cash generated by operating activities to the operating free cash flow as described in Exhibit 3 and Note 4, Note 6. Okay, let's just see. Where's the Note 6? Am I missing out something? Okay. Toobasco has defined net operating free net cash flows as net cash generated by operating activities as generated for the net capital expenditure, purchase of associate and dividend received, interest received and paid. Any exceptional items should be excluded from the calculation of the free cash flows. So I'm just copying it here and I'm just pasting it here. Format cells, alignment, rep text. Okay. This is what they have defined this. Now what do you need to do? You need to actually perform a reconciliation from the net cash generated by operating activities to operating free cash flows as described in Exhibit 3. So this is here. Can you take a picture of this, please? Can you take a screenshot of this, please? Yeah, can you take a screenshot of this, please? Okay, now can you take a screenshot of this, please? This page also, this here. This and now this. Can you try to calculate the operating free cash flows now? Giving you 5 minutes, try to calculate. Okay, let's try to discuss this. It says it defined the operating free cash flows as net cash generated by operating activities as adjusted for net capital expenditure, purchase of associate, dividend received. Any exception item should also be excluded from the calculation of free cash flows. See, operating free cash flows is this 334. Operating free cash flow is 334. Net capital expenditure, purchase of associate, dividend received, interest received, interest paid, exceptional items. So you're trying to calculate the operating free cash flows. How would you do it? Just try to see this. You would say, okay, from the question, we had the net capital expenditure of 46 million. So whatever the net capital expenditure of 46 million, you have to minus this. Net cash from operating activities. The net capital expenditure needs to be deducted, right? Then what actually happens is that we have got some details about the associate. He told us here that Toobasco purchased a 75% interest in associate. Associate reported a profit of 16 and paid a dividend of 4 out of these profits. In the year ended, directors had incorrectly included a figure of 12 million in cash. The associate was correctly recorded at 23 million in the statement of financial position, and profit or loss of 4 million was included in the statement. Now see, you purchase a 25% interest in associate for cash. When do you want it to end? Faith, when do you want it to end? Okay, it says on 1st September, Toobasco purchased a 25% interest in an associate for cash. Okay, no worries. We'll just try to see to what extent we can take this. Toobasco purchased a 25% interest in an associate for cash. Okay. Associate reported a profit after tax of 16 million and paid a dividend of 4 million out of these profits. Okay, so these are the profits. Directors included a figure of 12 million in cash generated as the cash generated from investment in the associate. Invest as associate was correctly recorded at 23 million in the statement of financial position at 31st August X8. And profit for the year of 4 million was included in the statement of profit or loss. So now see, what happens is that means you should know that how the investment in the associate is to be accounted for. You should know how the investment in the associate should be accounted for. Now let me just guide you this. Basically, let's just come on to it and see investment in associate. Cost of acquisition, share of profits, less share of dividend. So here what do we have? We have got 23. And he says this is correct. What is the share of profit? 16 million was profit and a dividend of 4 million. 16 million into 25%. 4 into 25%. So hence this is going to be what? Always remember, whenever you move in the opposite direction, just so hence the cost of acquisition is going to be 20 million. Just change the sign in the opposite direction. 1 million was to be deducted, it has to be added up. 4 million was to be added, it has to be deducted. So 20 is the investment in associate. The purchase of associate was 20 million. The associate was purchased for 20 million. The associate was purchased for 20 million. Right now, the dividend received. What do you need to do with respect to the dividend received? How would it impact the cash flows? So it would impact the cash flows like that the cash flow would be increased. 1. The interest received of 10. Interest paid. I think we did some adjustment for the interest paid also. That the interest that was paid was how much was the interest paid? 25 million into the property, plant, equipment and inventory. So the above cash flows, when we calculated these cash flows, what did we do with respect to interest? The interest received was removed from here because it is not included in here. Now we add it up again. Okay, the interest paid was added up. Now we need to remove it. Now what are the exceptional items here in the question? Are there any exceptional items? He did mention something about the exceptional items. That what are they? Can you just read through it? Exceptional are the extraordinary items. Yeah, can you just read through it? Some non-recurring items, right? So we could just see that which one of these items was non-recurring here. He made an exceptional contributions to the pension plan of 33, but the statement of cash flows had not recorded the cash tax benefit of so and so so and so. So the net that you have is that pension contributions, which is 33 minus 6, because you have received a 6 benefit also. So hence resultingly what would happen is that this is operating free cash flow. This is operating free cash flow, right? This is operating free cash flow. Now, if any one of you has got any questions in here, you're most welcome to ask. Operating free cash flow. Yeah, is that okay? Now, last requirement, an explanation of the adjustments made in 1 and 2 above. So you have to explain each one of the adjustments that you have made, and you will get marks for it. So you'll have to explain each one of the adjustment. Do you need the explanations of these adjustments? Okay, I'll just copy them here. I'll see if I can copy. Okay, I can copy good enough. I will just have to sort out a bit. Okay, can I copy here? Yes, I can. Okay, the associate share of profit of 12 is a non-operating cash flow, and instead it is a investing cash. The interest received of 10 is an investing activity as it arrived from the investments made. Cash from disposals of cars, 30 million. These cars were inventory and the cash flows associated with their acquisition and disposal should be recorded in the operating activities. The foreign exchange losses of 28 are non-cash items. Is the cash inflow and should reduce the taxes paid. The interest paid capitalized on asset is not an operating item but rather investing item, and its effect should be removed from the operating activities. Do you get all this? So like what you could do is that you could simply copy and you could just explain each one of them. You could simply explain each one of them. Is all good? Yeah, all good. Okay, lovely. So we are done with this specific question, the name of which was Toobasco Company, and it actually covered up the area of the group, it area covered up the cash flow. Plus, in addition to the cash flows, it also covered up the alternative performance measures, which is again a technical area and is like important from the perspective of the examination.